Hello everyone, and welcome to today's webinar. This is Matthew with iPlan Group, and I'll be your presenter today. Through our presentation, we do encourage you to interact as always, and you can ask questions to the speaker, and we will do a brief Q&A at the end. If you'd like to join the conversation on Twitter or Facebook, please do. Our Twitter is iLearnIPlan. We'd love to have you connect with us, and just want to give you a little background today on today's speaker. Bob Malecki is with REI Capital Investments, and today we're going to be discussing how investing in non-performing notes can provide double-digit returns for cash flow and equity. So he's going to cover the background of what these assets are, how they are available and how to purchase them, and he will also discuss exit strategies and possible profit potential for purchasing and repositioning distressed mortgage debt. Bob, are you on the call with me?
I am. Hi, Matt.
Hi. Thanks for joining us. I know we've been planning a webinar with you for a while now, so thanks for coming on to show us what you do and to do a presentation with us today.
Thank you so much. I'm looking forward to it.
So I'm going to go ahead and just turn the screen over to you and let you take it from here.
All right, great. Okay, thanks, Matt, and welcome to everybody. Thanks for attending. In my presentation today, as Matt mentioned, I'm going to discuss the advantages for investing in distressed mortgage notes, also known as non-performing notes. I'll also provide information on how notes differ from ongoing investments or owning investment properties, such as rentals and flipping, and also how to evaluate notes and the process for servicing them and the various exit strategies available. So a brief disclaimer, this is just an informational only presentation. It's not an advertisement soliciting for any particular purpose. Any securities discussed have not been registered or approved by any securities agency in accordance with the Securities Act of 1933 and state laws. We've gotten that out of the way. I'll tell you a little bit about myself. I've been investing in real estate since 2007. I'm located near Seattle, Washington, in an area called Kingston, west of Seattle. And I've been buying and selling flipped homes. My wife and I and some associates own some small multifamily properties in western Washington. We opened our Roth accounts late in the game in 2009. And we basically invested in our own LLC, a checkbook LLC, as you might call it, and we started flipping homes. Our first property we flipped, we had a gross profit or a net profit of $18,000, which put $9,000 into each of our Roth accounts tax-free. And since then, we created another self-directed LLC with another family member, and we own rental properties in both Memphis and San Antonio, Texas. And over the past 6 months or so, we've been purchasing notes. We currently have actually 6 notes in our portfolio now, and we're planning to add more. Our goal is to have up to 50 notes and between $15,000 and $20,000 a month net cash flow coming to us in our Roth self-directed IRAs. And I started REI Capital Investments late in 2012. With the purpose of allowing the opportunity for investors to pool their funds in this private equity fund and leverage my experience in flipping homes, owning rental properties, buying notes. And basically what we do is purchase distressed real estate assets and get them repositioned for performance. And our goal is generally 25% annualized ROI or higher of the capital we place into our projects. For everyone, it's a win-win. The homeowners, the community in which the homes are located, and our fund members who make a pretty decent return on their investment. So when I first began my research on non-performing notes, I thought, this is ridiculous to buy an asset that is non-performing, secured by a property that has declined in value from a bank that couldn't even get the borrower to pay. Plus, notes aren't as sexy as flipping homes or owning multifamily rentals. But what I found is that the low acquisition cost of a non-performing note allows for a lot of profit margin when we get the borrower to start reperforming on their debt. And yes, they're not sexy and require a lot of upfront due diligence, but I found that in the long run they provide much better cash flow and are less problematic than owning rentals or flipping houses. In this presentation, I'll show you how or why distressed notes are a better asset class, in my opinion, than owning real property, and how we select and evaluate notes for our portfolio. So why we buy distressed notes is basically I'm going to frame this and say I'm going to be speaking primarily in residential single-family home space. You can buy notes on multifamily, industrial, all kinds of other asset classes, but this presentation is going to focus on single-family. Basically, it's secured by the real estate, so by the home itself. If you get it reperforming, it provides ongoing cash flow similar to a rental. But you can purchase notes at a very low value ratio for what I call insane return on investment. I'll go into those ratios a little later. And the nice thing is, if you've ever owned rentals, and I'm sure some of you on this call have, not having to deal with tenants and repairs and insurance and vandalism and all the other things that come with owning rentals really makes notes attractive to us. The other thing is that I think they're easier and quicker to liquidate and offer a lot of exit strategies. I'll go into that as well. So I'm just going to cover real briefly so that we're all on the same page what a note is, what a mortgage is, so we understand their relationship to the property. Basically, a note is an IOU, but it's got obviously specific terms and dates. Anybody who owns a house or signed for a loan understands that. It uses the asset pledged as collateral, which in this case would be the home itself or the property. And it uses a mortgage or a deed of trust to bind that commitment, depending what state you're in. The note itself can be sold or assigned to another party, and that's how we purchase notes through an assignment after we evaluate them. And a mortgage is basically that pledge from the borrower that secures the promissory note they sign to the property. Some states call it a deed of trust, but they're very similar, and they all include a borrower, a trustee, and a lender. And there's provisions in that mortgage to allow the trustee to foreclose on the property should the borrower not perform on their commitment to pay the loan back. So why do banks sell notes? Well, basically, banks are in the business of making money by lending money. And the federal government has required them to hold reserves for every non-performing mortgage loan, which they have on their books, which means that they have less money to lend. They have to hold those reserves until they get that loan reperforming or liquidated. So when they sell that loan to the secondary market, they're able to raise new capital, which then they can redeploy and reinvest for a profit. We see that there's approximately a 3 to 5 year window of opportunity. There's a large amount of loans, toxic assets as we may call them, on the bank's books across the U.S., and there's a huge opportunity for buyers like myself and yourself in the secondary market to purchase these notes, invest in them, get them reperforming, and cash flowing. And the other good thing is that underwater loans are gaining equity. So residential housing market is going into recovery mode, as we've all seen. And we're finding that most markets are gaining equity and adding value to those notes we purchase. So I'm going to go through a bit of a scenario here. When we buy a note, we essentially become the bank. And typically, when a person buys a home, they borrow the funds from the bank. They sign a promissory notice to promise to pay back the loan. And a mortgage is created, which places the property as collateral for the loan. This provides recourse to the bank in case the borrower defaults on their promise to pay. The borrower then begins making monthly payments to the bank. If the borrower stops making those payments, the bank can foreclose or modify the loan to get the note reperforming with that borrower. And depending on the value of the asset backing that loan, the bank may do nothing but extend and pretend and eventually sell the note to the secondary market. We're seeing a lot of that activity at this point. What we do is purchase the note from the bank. It's now non-performing, and essentially become the bank. Because we can buy that note at a substantial discount to value, we can modify the terms to allow reperformance and cash flow. So how did these notes become non-performing? How did we get here? Where is this opportunity? Well, over the past years, we've been hearing many news reports about the housing recovery. It's been supported by facts, and here's some of the main points. So on the surface, it appears that we're out of the toxic asset woods and headed towards recovery, but I don't think it's really as clear-cut as the press makes it out to be. If we review what happened over the past decade that caused a surge in foreclosures and non-performing loans, during the heyday of the stated income loans between 2005 and 2008, as you can see on this chart, practically anyone who could claim that they had income was given a loan. Lenders stretched the income qualification level from an industry standard 3 times income to an outrageous level of 9.2 times pre-tax income. These were called stated income loans, where the borrower stated how much they made, and the lender took their word for it and used up to 9 times income to determine how much money can be loaned to that borrower. The banks and mortgage brokers qualified home buyers for mortgage loans at an unrealistic level, allowing them to purchase homes that they could not really afford. This, of course, was now called subprime lending. The results in subprime lending practices is the creation of a mountain of mortgage loans that eventually would default since borrowers could not sustain their debt payments. These are now known as toxic assets. So this graph from April 2014 report from CoreLogic shows that though the inventory of distressed assets has been declining since the peak in 2010, the seriously delinquent loans, which are in the red band, represent the majority of these assets. And these are mortgage notes that are more than 90 days delinquent and the assets with the most potential. It's estimated there is an upwards of 1.7 to 1.9 million loans that are seriously delinquent, represented in that red band there. The dark blue band is basically the REOs that banks have already foreclosed on, and the medium blue band is the shadow inventory of loans that are non-performing but not over 90 days late. So the volume of non-performing real estate loans has picked up dramatically over the 5 years as banks seek to shrink their balance sheets. The shadow inventory are mortgage notes that were seriously delinquent over 90 days, which banks would keep off the market for fear that the additional supply would cause prices to crumble further in the markets. A few years ago, banks would have been more inclined to foreclose on non-performing properties. They are now choosing to sell the notes. The primary reason is that for each dollar that they have in their books, as I mentioned before, on non-performing loans, they're required by the federal government to keep anywhere from 6 to 10 times the amount reserves. And now that these notes are climbing into the billions of dollars, banks are starting to unload them to recover their capital reserves. And so why don't they foreclose? Well, again, price pollution. They don't want to flood the market with foreclosed homes. It's expensive for them to foreclose. They have to pay staff, attorneys, services. As I understand it, it could cost upwards of $25,000 to foreclose on a house and get it back on the market as a bank-owned property. And when you're foreclosing on properties that are only worth $100,000, $150,000, or $75,000, the economies of scale just don't make sense. So basically, there's ownership overhead when a bank takes over a property. And they're in the lending business, not the property management business. So it's easier for lenders to extend and pretend rather than liquidate the assets. So there's as we understand it right now, there's approximately 200,000 bank-owned properties on the market that can be purchased at a small discount as investment properties for flips or rentals. But prices are rising, margins are shrinking, and it's becoming more challenging to find assets that will produce a reasonable profit margin. With an estimated inventory of over 1.7 to 1.9 million loans sitting in the shadows, sitting on the bank's books, I believe this is the opportunity which can provide very lucrative upside. In the next few slides, I'll provide an overview of what circumstances drive this. Why distressed mortgage notes? Well, basically, we're able to buy a distressed note or a non-performing note at about 35 to 60% discount of the as-is property value. So that's as-is, that's not fixed up. We can reposition it or get it reperforming for aggressive cash flow and capital gain over time. And what we're finding is our annualized cash-on-cash return on our investment is in the double digits and even in the triple digits if we have to liquidate the property through foreclosure. And basically it's pre-leveraged. So if you pay $40,000 for a mortgage that has a unpaid principal balance or UPB of $100,000, you've got $60,000 of potential instant equity depending on the value of the property itself. But basically the borrower still owes $100,000 on the note and there's interest attached to that. So somebody once said, I'd rather receive a mortgage payment than a rent check any day, and I agree with that statement. I'll tell you why. Rather than buying the distressed property and competing with thousands of other investors in the market, we see that buying distressed debt before the foreclosure process makes more sense and allows for greater margins. Traditionally, the real estate investment landscape was primarily comprised of purchasing foreclosed homes and renting them for cash flow. But as inventory shrank and costs of ownership are rising, we believe the opportunity lies in buying it before. And so there's a large amount of inventory of assets. As I said, 1.7 to 1 million loans are going to be released to the secondary market over the next 3 to 5 years. There's less competition. There's less note buyers in the market in the United States than there are general real estate investors. As I said, you can get the properties for a much lower acquisition price, 35 to 60% of the as-is value. And I'll go into this in a minute, but there's a lot of exit strategies, and because you purchased the note at a great discount, you can have a margin for error. So if a lien pops up or something that you didn't find in your due diligence pops up as an expense, generally your profit margin can absorb that hit. And so currently, foreclosure that you buy at the auction, you can maybe get it for 60 to 80% of the retail after repaired value of the property. But after you account for repairs, insurance, taxes, and vacancies, profit margins start to shrink, especially in this market of increasing values. So what we found is by purchasing the note on the house before it goes to foreclosure, we're able to acquire the note for a much deeper discount than we could have at the foreclosure auction or as an REO purchase. And so we have a much higher profit margin potential. And note that the note and not the house is owned, so that repairs, taxes, insurance, and so forth are still the responsibility of the borrower, not of me. So I'm going to get into a few descriptions of notes. There's two primary categories, senior position, first position notes. And those are senior to everything except property taxes, federal taxes, and in some states and counties, homeowner association dues. For instance, in Memphis, a homeowners association can foreclose on a property ahead of the first position lien holder. There's second position notes, which are of course subordinate to the first position loan, and usually a HELOC that was taken out on the property. During the 2006 to 2008, a lot of HELOCs were sold. We're seeing a lot of second position defaults now, and that's an interesting market, but we're focusing really on first position notes. There's two types of notes, performing or non-performing. We buy non-performing notes, typically 90 plus days late on payments. The bank's already written it off, so they sold it to the secondary market as in a pool generally. And these can be purchased and repositioned for basically high performance returns. A reperforming note generally will have a seasoning of 6 months or more of consistent payments from that borrower. And they're either created as reperforming notes or a loan modification, or they were notes that were generated or originated by a homeowner on an owner financing basis. One of the main things in buying notes that we found and that every note buyer has to go through is risk mitigation or due diligence. So generally, when we review a note to purchase, we'll look at the value, do a very quick top-down value online using one of the online portals like Zillow or Trulia. We may order a broker price opinion called a BPO, where we actually hire a company, goes out and hires a broker to go out and look at the property, do pictures, and do a local valuation, and then files a report that's sent to us. But eventually, if we make a bid on a note and it's acceptable, then we get the collateral files, which include the deed of trust, the promissory note, assignments, possibly the borrower's application, evidence of title insurance, And we go through all those documents and make sure everything is in place before we actually purchase the note. We also can order title reports, lien reports, look at servicing notes from the current servicer if they're available. And we determine if there's, first of all, if there's a borrower located in the property, is it vacant or is it occupied? And is it occupied by the borrower? Do they want to stay in the house? Are they able to pay? Are they able to reperform? We'll also go through tax records, look for additional liens, and just basically get our brains around that note to see what potential it has for reperformance. Eventually, we come to a very quick investment to value ratio. We look at what our offer price is, plus any unpaid taxes and liens, plus any anticipated foreclosure fees should we have to foreclose on it. And we divide that by the current as-is value that we got from that BPO analysis at the top of the screen. And that kind of gives us a ratio. So to lower the ratio, let's say you buy a note for $50,000 and the unpaid, the value on the property is $100,000, you're at a 50% investment to value ratio, which isn't bad. You've still got a lot of headroom there for profit or for liquidation and recovery of your capital. Once we buy a note, then we have to manage it, and we outsource just about all the services. There's a large network of third-party servicing companies which grew to meet the needs of the bank over the past decades. And these companies can be deployed by smaller investors such as my company to perform the distressed note repositioning procedures needed, and allows us to scale our business model without having to hire internal staff for most of the processes. So one thing that's key is servicing, making sure that the borrower is sent statements and has a place to pay, and that reports are filed and tax reporting is done and so forth. There's title reporting companies, there's services to record your note once you buy it at the local county. Foreclosure services, you can hire a property preservation service to go out and board up the house should you have to foreclose on it, keep the grass cut to stay within city ordinances and so forth. And then there's a team of attorneys usually working with these servicing companies that can be outsourced for foreclosure if needed. But basically myself and my staff perform the analysis and management of those notes and direct all these services to work with us for the benefit of both the homeowner and our needs as well. So notes, as I mentioned, have quite a few good exit strategies. Our preferred exit strategy is a loan modification, where we work with the homeowner to get them to reperform, to stay in their house. We can do this by reducing the APR. We can lengthen the term of the loan. We can reduce the principal balance. And basically, because we bought that note for theoretically pennies on the dollar, we have a lot of margin to reposition that note with that borrower, get them reperforming. And I'll go through a few examples later on in this presentation. There's also the short sale process. The borrower could put their house up for sale and propose a lower payoff for the sale of the property. And again, if the house is worth, let's say, $100,000 as is, and we get an offer of $70,000, but we've only paid $50,000 for the note, there's a $20,000 margin. The borrower gets out of their house, somebody gets a house at a discount, and we make a profit, so it's a win-win-win across the board. There's a deed in lieu, basically cash for keys, where the borrower, if they can't perform, they just don't have the ability to pay their mortgage, we'll give them the opportunity to sign over the deed to us, walk away from the property. Then we can liquidate that property as a bank-owned REO and sell it perhaps to an investor who's looking for a rental property or a family who's looking for a fixer to move into. And last but not least is foreclosure. We can basically go to the foreclosure auction and sell it at the auction, or if it doesn't sell at our strike price, we can take it back and sell it to the secondary market, or keep it as a rental, or sell it with owner financing. Foreclosure costs range from $2,000 to $4,000 depending on the state it's in, being foreclosed in. So I'm going to go through a few examples here. This is a note we acquired a few months ago. It's in Charlotte, North Carolina. It's a little two-bedroom house. It's got a value of about $30,000. The unpaid principal balance on it was $50,231, and the borrower borrowed the money in 2001 at 11.15% at a monthly payment of $524. So this was definitely a stated income loan, as I can see. He stopped paying in 2009, lost his job, and accumulated over $22,000 in arrears. So he became recently employed and submitted a hardship letter and wants to stay in the house. His mom lives with him. We found all this out in our due diligence, and we purchased the note for $13,800, including broker fees, and we've probably got more like $14,000 into it after other miscellaneous fees. So our exit strategy on this one is reperformance, our preferred exit strategy. So what we've done is modified the loan to 7%, re-extended his terms to 30 years, and he has volunteered to pay $10,000 towards his arrears, and we forgave the remainder of it. So basically, on a $14,000 investment, we've recouped $10,000. Our net return on investment with his 356-month payment is over 90% per year on that investment. If he can't reperform, if he stops reperforming and we have to go back to foreclosure, we can probably get $25,000 to $30,000, probably $25,000 for that property on the market, which still gives us about a 60% return on our investment. Our goal is to not foreclose on them, though. Some investors, their main business model is to buy vacant properties and foreclose and then flip them out or rent them out. Our business model primarily is to keep the borrower in the house, get them reperforming, and collect the cash flow over time. Eventually that borrower may sell the house, or they eventually will sell the house probably, unless they have an inheritance upon death, but generally they'll sell the house or maybe refinance it in somewhere between 5 to 7 years on industry average, and we'll get the balance of the unpaid balance back. So theoretically, if the house increases in value over the next 5 years and goes back to somewhere in the value range of $50,000, we'll get a windfall profit when that borrower sells their property. Another note that we have is, go back here, there we go, in Wadesboro, North Carolina. Again, this is a 2-bedroom house. It's got a current value of only $17,000. Wadesboro is fairly rural, as I understand it, and the original loan balance was $72,000. We bought this as a reperforming note from another company that got it reperforming. It was non-performing. They modified it by reducing the principal to $40,000. They increased the APR to 7.5%, but it provided the homeowner a new monthly payment of only $250 versus her previous payment of $536. So we paid $8,800 for that note, including broker fees. And our annualized ROI based on that $250 a month payment is 34%. Not bad for, under $9,000 investment. And this is the kind of values we're seeing in non-performing notes. So let's talk a little bit about ways to buy notes. Just get my screen moved over here. There's a few different ways to buy notes for cash flow. All these methods can be done using your self-directed IRA, as I have done in mine. You can originate a note. Basically, you can loan money to somebody to buy a house, and generally you have to be aware of the Dodd-Frank rules, the consumer protection rules, but you may loan money for an investor to buy a rental property. Now you've just originated the note. You can purchase a seasoned note from an investor who's got it repositioned or from another investor who originated a note. And you can get them for as low as 75 cents on the dollar and enjoy a fairly moderate but steady income stream. Typically, reperforming notes or seasoned notes will have a yield of 12 to 15% annually. You can do what we're doing and purchase a non-performing note at a good discount and reposition for cash flow and that high ROI that I portrayed in our previous examples. Or you can combine your investment dollars with other investors and let the fund manager use his expertise to reposition the notes as we do and create high performance profits, being more or less of a passive investor in that position. So just to give you an idea of what our note acquisition profile is, an example is We basically have established relationships with hedge funds and brokers across the U.S. who have inroads into these pools that are being sold by the banks. We target anything at 60% or below the as-is value for the note. That's one of our criteria. We look for homes that are owner-occupied, where we can get the owner to stay in and reposition their notes, their payments, get them reperforming for cash flow. And as I said earlier, the note can yield 30 to 70% annual cash ROI, and if we have to liquidate it, anywhere from 150% on up. So as long as you do your due diligence at the beginning very well, and you know that everything is copacetic with the note, and you don't have any major liens or government taxes that are going to bite you in the butt at the back end, you can really get non-performing notes to reperform. So to summarize, basically, I think notes are better than owning properties in that they can be purchased at bigger discounts. They have more exit strategies, which allow you to get your ROI, your velocity of cash quicker if you're going to liquidate. Multiple asset classes are available. I'm talking about residential homes right now, but there's multifamily notes, there's notes on industrial properties, on shopping centers and gas stations, and there's note companies that even buy debt, credit card debt, lottery winnings, insurance claims, and so forth. But the main thing from my chair is that those headaches associated with property ownership are mitigated. I don't have any borrowers calling me on a Sunday evening telling me their toilet's clogged. If they do, I'm sorry for them, and I hope they get it fixed. And it's scalable. So with a small team, we can use those third-party services that were established for the banks and deploy them out at very reasonable pricing to get analysis and servicing done on the properties. And in the long run, it provides for ongoing cash flow and capital appreciation. So these notes that we're buying are going to provide us cash flow, and when that borrower sells their house or refinances, then we get a capital injection from the payoff of that note. So that's it. Do we have questions?
Yeah, we actually do have a few already here, and folks on the call, if you want to type in additional questions as we go along, we can just have Bob kind of go over those with you. I've got one question for you, Bob, if you don't mind. So when you look for these notes, do you look for them in a certain area of the United States?
Yeah, actually, you notice the two notes or examples I provided were in North Carolina. There are what's called judicial and non-judicial foreclosure states. Judicial foreclosure state means that you or your attorney has to go to court and file for foreclosure, which takes quite a while. A judicial foreclosure state can take anywhere from 6 months to, in New York, as I understand it, 3 years to foreclose. A non-judicial foreclosure state generally will have a 3 to 6 month window for foreclosure. So if the borrower cannot pay and we do need to foreclose, we can get in and get out fairly quickly in a non-judicial state. In addition to that, there's 17 states that are under the Hardest Hit Fund, which is a federal program that funds each state with multi-million-dollar capital, and these states can then provide financial assistance to borrowers, help them pay off their arrears, help them pay their taxes off, and essentially, if a borrower qualifies for Hardest Hit Fund assistance, we could get the capital paid back on their arrears very quickly. So we try to focus on that kind of cross-section of Hardest Hit Fund. North Carolina, South Carolina, Tennessee, Georgia are all Hardest Hit Fund states, and other than South Carolina, the other states are non-judicial. So yeah, and also the states, different states have different purchase values. If you buy a loan in Detroit or Illinois, it may be a little less expensive than notes in California, where there's very rapid appreciation right now, and as well as Florida. Note sellers are selling those for more like 60 to 80 cents on the dollar, where we can buy notes in the southeastern United States for 20 to 40 cents on the dollar.
Okay. Good to know. So it seems like it is a very targeted business.
Absolutely. Go ahead.
Yeah, can you buy notes in like in a certain area and maybe sell those to once you take back the property, maybe sell it to like a rehabber or a wholesaler? Do you have when you do have these properties in your inventory, what's your target market when you go to sell them?
Basically, yeah, there's another business model that I'm exploring as well. It's because I have relationships in Memphis, Tennessee with wholesalers and rehabbers and investors there, is possibly buying notes on vacant properties and then just flipping them over to a wholesaler for a quick profit. But the notes that we keep, our goal is to keep them for cash flow and eventual payoff and not resell them. Unless we need to raise more capital, we could. But generally, as a small note investor, especially if you're buying in your IRA, you would probably go through a note broker who will offer you a small pool of notes, let's say anywhere from 10 to 600 notes in a pool, and they'll allow you to cherry pick one or more of those notes out of the pool. You're going to pay a premium price, but you're able to buy a note, a few notes at a decent value, and hit the road running with those notes. With REI Capital, as we raise more capital into the fund, our goal is to buy larger pools at a higher discount, cherry pick the notes we want out of that pool, and then liquidate the rest as brokers to individual investors who are looking for singles.
Excellent, great. Okay, so I'm going to jump into some of these questions from the audience here. So Aline wants to know, won't the bank sell the note for the amount owed? So I think she's asking, do they normally want the amount owed, or
no?
Or is it pretty common for the lower amount?
Yeah, and I didn't get into the acquisition process in too much detail, but first of all, just to clear it up, in general, you're not going to go to a bank to buy a note. B of A will not talk to you. Even local portfolio lenders are difficult to get a discussion with and buying individual assets from them. The large banks like the B of A's and GMAC and Chase sell their notes in very large pools. We're talking $50 to $100 million pools. And so those pools are bought by large hedge funds who will generally resell those to smaller funds who, they might slice and dice them up into $5 million pool or a $10 million pool or a $2 million pool. And then those hedge funds typically on that tertiary market will start cherry picking the assets they want to get reperforming that work for them, and then sell off whatever they don't want to the brokers and individuals such as myself and my company. So to answer her question, when the bank sells the notes to the large hedge funds on a $50 or $100 million pool, they're going to discount that note probably down into the below 10 cents on the dollar average, depending on the region. And so every time that pool gets broken up and resold downstream, the price goes up because everybody's got to make a markup, so to speak. It's a distribution channel, essentially. So a note that was originated from, let's say, B of A may have been sold to the first hedge fund for 9 cents on the dollar, and by the time I get it, it might be 35 cents on the dollar. But they're selling them at a steep discount to unload them. If they can get full price for the note, they wouldn't sell it. They'd keep it because it's a value to them. But for now, they're unloading it at whatever the market will bear, and it's pennies on the dollar to these hedge funds.
Excellent. And then here's another one from Brian. Are you buying through Note School or another hedge fund?
Not through Note School. Eddie Speed offers an excellent product, and he has a great group over there, which is Note School. No, I'm buying these from other hedge funds. I've established relationships with brokers and small funds like Condor and Granite Loans. And the brokers I've met through, I've sourced through mainly through LinkedIn. LinkedIn's a wonderful place. If you get on the LinkedIn and just do searches for distressed debt, distressed mortgages, you'll start finding groups where you'll see that brokers are posting notes for sale and small pools for sale. And the thing to watch out, of course, is what both Eddie and Scott Carson call joker brokers, and these are people who are 3 or 4 tiers down on the chain, and they're trying to resell some other broker's pool, and you learn very quickly after you start seeing the same pool, or what we call a tape, being sold by 3 or 4 different people, or sent to me by 3 or 4 different individuals. You know that they sourced it from somebody farther upstream. But generally, I'm buying through brokers, I'm buying through smaller hedge funds, and able to find fairly good assets in that realm.
Excellent. Okay, Arlene would like to know, is there a way to invest using private money?
Oh yeah, absolutely. Well, we REI Capital is a private equity fund, so essentially we are using private money. If you've got funds that you want to buy a note with, you can, once you make contact with your network of sellers, you can just use your funds, or you can use your IRA money. Either way, they have no preference as to where the money comes from, as long as it's all legal and above board.
Okay, so it sounds like you can take in private money investors and then go out and your company can purchase the notes. So private money definitely is an option. Okay, good. So let's see, we've got another one. This is from Aline, what is the minimum investment for your fund?
Oh, with REI Capital, our minimum is $25,000, and up from there, and we have a preferred return that we pay based on the investment amount, as well as a 50% split of profits at the end of the year. And if you're interested, you can contact me offline. I'd be happy to tell you more about it.
Okay, and then Joe would like to know, so how do you work with others? And I think you kind of answered that.
Yeah, in general, and I am offering, I think, Matt, you're going to probably send this out on a follow-up, but I am offering a 20-minute free consultation for anybody that wants to kind of get more information either about REI Capital or just about how to buy notes and get started and so forth. But yeah, we work with individual investors who want to pull money. We've also done JV. I've done separately JV, joint venture arrangements with a few different investors to buy properties or buy notes. So it just depends on who the investor is, how much they have, how they want to participate, what their risk toleration is, and so forth.
Okay, and here's a really good question from Tina. How about when the borrower files bankruptcy?
Good one. Yeah, bankruptcy, when I first started buying notes, bankruptcy was this big fear, but actually, in general, there's 2 types of consumer bankruptcy, Chapter 7 or Chapter 13. And Chapter 7 is where the bankruptcy filing, all non-secured loans are wiped out, like credit card debt, that kind of thing. And mortgages are not wiped out, but the borrower's obligation to pay the mortgage, essentially is wiped out, but the debt still is attached to the property. In a Chapter 13, that's a reorganization where the borrower has to pay back all their debts, but they're usually negotiated to a discount or change of terms and so forth to give them some relief. On a Chapter 7 is more severe in terms of a mortgage debt than a 13. And we actually, one of the first notes I bought was a HELOC on a house in California that was a $100,000 unpaid balance, and the borrower had filed bankruptcy in 2009. Well, we can still foreclose on that loan, even in second position, because the debt is still valid on the property. I can't contact the borrower. They filed bankruptcy. Consumer protection laws do not allow me to contact them. I can contact their foreclosure attorney, but essentially if they don't start reperforming, then we have the option of foreclosing on the house, taking it back, and then liquidating it to recapture our unpaid principal balance.
Okay, good to know. And then let's see, Arlene would like to know, do you have a teaching or coaching program?
No, I don't do any coaching or teaching. There's a few coaches out there. Eddie Speed does. If you want to Google him, he offers an excellent course. He does weekend boot camps. I've attended a few of them. He's been in the business for over 30 years, and he's a walking Bible of note knowledge. There's other coaches out there. Scott Carson offers a good course. Just, be careful, and, when you go to these events that they hold at the local RIA groups and whatnot, they tend to get you all psyched up, and, like any other course, just, give it a day or two, think about it before you enroll. And you can get a lot of information online. Go to Bigger Pockets is a forum online, and there's a notes and section there, and there's a lot of people, including myself, who provide advice. I started there with my stupid questions, and all the mentors there are wonderful, so I encourage you to get on there and kind of look at some of the postings and questions that were posted over the years. You'll learn a lot.
Okay, good to know. And let's see, next question. Scott would like to know, I want to buy and work notes myself. Can I buy directly from you, or do I need to go to the hedge funds or brokers myself?
We actually have some agreements with the brokers to redistribute their tapes. They're small pools, and we charge a small fee for that. If you buy the note, we don't charge you anything just for looking at it. So yes, we can provide some assets directly from our company, as well as give you information on how to contact the brokers. It's really more or less. I work with some newer note investors in my RIA group here in Seattle, and they don't have the wherewithal to find these brokers directly, so they get on my list, and I send them a tape when I have it to say, okay, here's the assets, here's the parameters around it, let me know if you have interest in any of them, and then if they do, then I would propose those to the broker and propose a purchase price and so forth.
Excellent. Good to know. So here's one from Kim. I've been calling banks with lists of high numbers of REIs asking for special asset managers. Have very little success with contacting these people. Any ideas?
Well, like I said earlier, generally banks aren't going to typically deal with a small investor, a single purchase investor. Their goal is to liquidate these assets in bulk, and so they're dealing with hedge fund managers and negotiating in the multi-million-dollar range. They just don't have the capacity and the wherewithal or the business model to sell individual notes. So, my advice is start looking for brokers on LinkedIn, start getting in touch with Condor and Gemini and Watermark and these smaller hedge funds who already have their relationships in place, and buy through them, because they're going to provide you decent quality assets at a reasonable price, and they've already done the negotiations with the banks. But talking directly to the bank, I've not even attempted it. I've just looked at that idea, and it just doesn't make sense to me. Why would a asset manager at a bank talk to somebody who calls them to buy 1 or 2 or 3 notes when they're dealing with a hedge fund manager who's buying a $10 million pool,
Right. Yeah, exactly. They're going to go for the easy money. How does, Jake would like to know, how does investing in your fund work?
Basically, investors sign a subscription agreement where they're agreeing to subscribe into the fund. Then they wire the money in, and their funds are pooled. This is a Reg D 505 filed fund, so it's all filed with the federal government as well as the states in which our investors are located. And their capital then is deployed into the purchase of non-performing real estate, such as right now we've got a few small multifamilies in Western Washington, and we're buying notes with the rest of the capital. And then they receive a preferred return on a quarterly basis, distributed quarterly. And then at the end of the year, we look at what our expenses were. We look at what our gross profit is minus our preferred return to our investors, minus an asset management fee, and other expenses for accounting, bookkeeping, and so forth. And then the net profit is split between the managers of the fund, being mostly myself, and the investors on a pro rata basis, depending on what their capital account balance is.
Okay. And Ken would like to know, can you purchase a second non-performing note at one time, or do you have to buy a pool of notes?
Oh, no, you can buy individual notes. Again, through these brokers and the small hedge funds, they will sell single notes, and you can buy one or more from that pool at any time, essentially. If you buy, you'll get a better discount if you buy a pool. So if you buy 10 or 20 or 30 or 100 notes, you're going to get a better price on those notes than if you buy 1 or 2 or 3 notes. It's just economies of scale. Generally, when you buy a small pool, though, you may be able to pick what states you want to buy in. Sometimes it's, I've seen pools come across that are take it or leave it. We have 60 notes in this pool, and they're all over the country. They're in Boston and New York and California and Chicago or wherever. And you just have to buy them knowing that you'll need to liquidate a certain amount of them that don't fit your criteria.
Okay. And let's see, we've got a question here from Dean. What is the ratio between properties which you end up foreclosing on to modifying?
Roughly, it is about 40% for foreclosure. I'm sorry, 40% for modification, 40% deed in lieu, and 20% foreclosure is kind of the general industry averages for ratios.
Okay. And Sherry would like to know, how do you find a note broker? I think you covered that earlier about LinkedIn, right?
Yeah, in general, LinkedIn, and also that's not the only place, of course, but if you attend note conferences, there's Noteworthy that's coming up this fall in Las Vegas, and there's going to be Note Brokers Deluxe there. Jack Sternberg provides this symposium, and he's got a lot of speakers who teach in these forums during the conference. But it's out in the hallway with the note brokers and the service providers that you start building your relationships, getting business cards, and moving forward on finding notes through these people.
Very good. Okay, let's see. John would like to know, does your firm offer notes only through a fund structure or offer individual situations? Can you describe the fund terms, i.e. duration and fee structure?
Okay,
something you would do what on more on a one-on-one, but yeah, but I'm interested in hearing too, kind of the general premise there.
Well, I'm sorry, could you repeat the question one more time?
Sure. This is from John, and he says, does your firm offer notes only through a fund structure or on individual situations? So I think he means like, will you sell a single note, which it sounds like you will. And then he says, can you describe the fund terms, i.e. the duration and fee structure?
Okay. Yeah, and so the answer is yes. I mean, the fund basically buys notes and gives a return back to the investors in the fund. But if somebody approaches me and says, hey, Bob, I'm interested in just buying 1 or 2 notes, I don't have the capital, or I don't want to invest in the fund or whatever, then I can put them on my buyer's list, and which basically is an email blast list that gives them the opportunity to review small pools as they come across my desk, and they can buy a single note through that process. As far as the fund, I have described kind of what the returns are. This fund is a 5-year window for sunset. The management fee that we charge is 1% of the assets under management, and that's taken concurrently with the preferred return paid back to our members. And if for those who may not understand, a preferred return means that the investors get preference. They get first position of distribution of profits at their 7 to 9% return before I get paid, before anybody else gets paid. So that's what preferred means. And so in terms of the profit split, it's the gross profit minus the preferred return minus my asset management fee, and then that's called the net profit, which is then split up at the end of the year.
Okay. Kathy would like to know, do you need a self-directed IRA? I think she's referring to investing in your fund or individual notes.
Right. No, you don't. I mean, I'm buying a lot of notes in my self-directed IRA because I want to set up cash flow for my retirement. But there's other note buyers who are just using their own money or putting together small funds like I am to buy notes. So yeah, the answer is you don't have to use your self-directed IRA to buy notes, and you don't have to use your self-directed IRA to invest in my fund. It's just whatever works for you individually as an investor.
Okay, great. Tina would like to know, can we get a replay of the webinar? Absolutely. We always send out replay links about within a week after the webinar. So if you're on our email list, you will get a email containing the replay link. So we do send that out, and we also place it on our website as well. Let's see, Brian would like to know, with most of your assets being real estate, how are you hedging against a downturn in the market?
Well, it's buying at a good price and buying in the right regions or the right parts of the country from my perspective. Basically, with what I'm finding, with notes versus owning actual hard assets or real property is that with a downturn, let's say I did this before the bubble burst in 2008, and I had bought notes on properties that had a very high value at the time. Well, if I paid 30 or 40 cents on the dollar for that note, and the value of that property has plummeted 50%, there's still a 20% margin of profit in that note, even in the downfall. So really the key to it is buying as least expensive as you can with the lowest amount of liability or, of unpaid taxes, liens, and so forth. And that's the magic, to me, the magic of notes versus buying properties at the auction or owning the property is you generally can't buy a house in a decent market for 30 cents on the dollar. You're going to pay 80 cents on the dollar probably, but you can buy a note for 30 cents on the dollar. And so even if that area goes downhill over a certain period of time, and we know real estate's a roller coaster, it goes up, it goes down, and it roller coasters from region to region, state to state. So I just identified what makes me comfortable and in terms of my risk for the regions and the notes kind of assets I buy. And it's really just a lot of research and due diligence and then making deliberate decisions and sticking to those and not being tempted by some cheap note up in Maine that is a really great deal, but I have no idea how Maine performs. I don't care because that's not an area I want to focus in, for instance.
Okay. Let's see, we've got a couple more questions. Are you okay on time, Bob?
Sure, yeah, I'm fine.
Do you have time for, let's maybe just keep it to 2 more questions, and then people can always reach out to you, via your phone number or email on the screen there. But
absolutely.
Kathy would like to know, did I understand at the beginning of the presentation that he has only 5 notes? I don't think, I'm sure you have more than that, right?
Yeah, I just was talking about my self-directed IRA that I purchased.
Oh, in your IRA, okay.
Yeah, now 6 notes in it as we move forward, and we're actually, we have some rental houses in Memphis that we're actually liquidating now, and we're carrying back seller financing, so we're essentially turning our rentals into notes where now I don't have to worry about paying insurance and taxes on those rentals. The person that we're selling them to is just going to pay that.
That's very interesting. Let's see here. Okay, so yeah, we're getting some more questions here. So we've got, so funds keep the notes in good regions and sell bad areas. I think you covered that already. Basically said you only buy in your preferred regions.
Right.
Yeah, Scott. Once we invest in the fund, are we locked in for 5 years, or can we divest?
You can divest. The PPM or private placement memorandum, which is the kind of the rule book for the fund, says that we require you to stay in for at least 12 months, and that you can exit the fund, request an exit, and we will do our very best to liquidate something to get your capital back or find another investor. And there's also various parameters in the PPM that allows you to give us first rights of refusal to buy back your membership stock, so to speak, or for you to sell it to another investor under our approval.
Okay. And let's do one last question here from Dean. What are the best places to buy? States with best potential? Is there a website for that?
Wow, that's a good question. I don't, I mean, it depends on what you're looking for. I mean, buying, if you have the capital, I would say California and the West Coast, it's appreciating, so you're buying into an upswing market. Florida has a lot of potential. It's still near the, kind of at the bottom with Las Vegas, but it's appreciating as well. So, and Texas is a great state to buy in because, again, the economy in Texas is doing great. There's employment there. The unemployment rate's low, and it's a fast foreclosure state. But you're going to pay premiums because any investors who are buying in Texas are competing with other investors, and so prices are going to go up in those regions. That's one reason I picked the Carolinas. Is it's not a major big appreciating area, but Memphis has got a good employment base. North Carolina does, just because car companies are building plants there, and there's some industries going into the Carolinas that keep the employment there. And as a real estate investor, whether you're buying notes or rentals, if you have a high unemployment rate, it's going to be higher risk. So I try to buy in an area that's got good employment statistics and fairly good projections in the future.
Excellent. Well, that's all of them, Bob. I really appreciate you hopping on today. That was excellent information. And
thank you.
I really like to have, I wanted to have you on for a while, and like to have this type of investment on our webinars, because it is considered an alternative asset, and that is something that you can invest in with your self-directed IRA. So things like this can really help an IRA portfolio grow exponentially. So thanks again for coming on. We'll have to do some more training in the future, and we look forward to working with you.
Thank you very much, Matt. It was great to be on.